Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Scott Kerschner, and Chaz Price. 419-794-3030. That's the phone number. Get in touch with the team, the Retirement Guys Formula, 419-794-3030 or arhq.com. As part of the planning process, you guys help clients better manage their money, protect their assets, and efficiently plan their estate. You've often said that going through this process, which you guys have dubbed the independent income system, make many investors finally understand the purpose, for every account, how it's all allocated. But one of the things that could blow it up, an unexpected healthcare crisis or, the death of a spouse. And that's why you guys also incorporate insurance planning into the process. One of the more popular insurances out there you use is indexed universal life insurance. Let's take some time right now, guys, and explain how those policies work.
I think first what we need to do before we even get into that is what are the different types of life insurance? It's kind of surprising to me the number of people that really, it's life insurance. They don't know that there's actually different types of life insurance. We have what's called, and what I always refer to it as the temporary insurance. Temporary insurance is where it's actually term. It's for a specific period of time. You write a 20-year term, you have a guaranteed death benefit, guaranteed premium for that 20-year period. At the end of that 20-year term, you have options. You can renew it on an annual basis, or you can just let the policy go away. You may not need it at that point, right? And then the other type of insurance is what I call permanent. It's also known as permanent insurance. And that is where you're going to have some cash values built into it. Like you're going to have a whole life policy would be considered in that permanent insurance environment. Your index universal life policies, your variable life policies, all of those type of policies that have cash values built into them, as long as you pay your premiums with adjustments, you're always going to have the life insurance. It's not going to expire in a certain period of time. So those are the types of insurance. But, talking about how does an indexed universal life policy work, why don't you go ahead and give the listeners what they need here?
Yeah, and it's definitely been an option that I've used for quite a few years with clients. And I think when we look at it, there are different types of needs and, what people are looking to accomplish. Again, if you're looking to provide for some coverage for your family while your kids are little until the mortgage is paid off, maybe term insurance is great. But if you want something that's more of a permanent solution, usually what I do is I look at the policies that are trying to incorporate a lot of different benefits all together in one. For a lot of folks, when they're looking towards retirement time, we want to address the issue of what happens if their health changes. Mm-hmm. So a lot of these policies, they have critical, chronic, terminal illness coverage that can cover and help provide some income if somebody has a heart attack, a stroke, a diagnosis of cancer. Maybe they get into a major accident and they're unable to perform some of their activities of daily living, all the way to down the road when, we traditionally think about things like nursing home. Mm-hmm. A lot of people will think of long-term care insurance. And, I like using life insurance as an alternative to traditional long-term care insurance. And then specifically, I like the Index Universal Life Policy. So it's a type of cash value life policy. It offers a death benefit to the beneficiaries while that cash value component, it can grow over time. When we look at it, as you talk about, there's a certain amount of premium that somebody puts into the policy. Mm-hmm. I run into a couple of different scenarios when we're looking at how people are funding these. One, they might look at redirecting some dollars that they have. So we just did a segment talking about, should you max fund your 401k? And maybe the answer is not all the time. If you wanted to redirect some money, this could be an option where you could do that. Maybe in other cases, we find people that have a lump sum of money set aside and what I call lazy assets. Mm-hmm. So they can take a one-time deposit and make those lazy assets get you more benefits. So it has this component that allows it to grow based upon the index performance. It has a death benefit. God forbid something happens and somebody passes away prematurely. And then it has that critical, chronic, and terminal illness coverage. For retirees, a lot of times, people that are over the age 60 that are more concerned about transitioning money and moving more money towards accounts that they've already paid taxes on and or transferring of wealth maybe to their kids, moving money from the traditional retirement accounts systematically each and every year can be another way that they can make those different types of premium payments. Now, it is life insurance. So as a permanent life insurance, if you have a strong policy, it's designed really to be there for your entire lifetime. So that death benefit is to who you name as your beneficiaries if you pass away. And one of the advantages is the death benefit is a tax-free payout. It's typically based upon the face value of the policy, minus any outstanding loans or withdrawals that somebody took. And it really, can be a benefit that can be a level benefit that you took out at the time that you selected the policy. And then it also can be an increasing benefit, meaning that these benefits go up over time. So the cash value part of an index universal life policy, what it does is it will credit interest based upon the performance of an underlying index. So some of the most common ones that we hear all the time would be like the S&P 500 index or the NASDAQ. And interest is credited typically subject to either a cap, a maximum return on an annual basis, or some type of participation rate, meaning you could get half the gains of 50% participation. So that allows you to participate when the market goes up. And the other advantage on why I like the index option is because in the event that the years go down, the cash value does not decrease because of the market decline. So you have some capped or participation on the up, meaning you get to have some gains when the market underlying index goes up, but you're protected against losses. There's a lot of different indexing strategies that are out there. Most of the policies give you 5, 6, 10 different choices of what the index is. And based upon your policy anniversary, you can change what those indexes are. With an index universal life insurance, you have policy charges and fees. So just like other life insurance, those charges and fees, want to become familiar with administrative cost. You want to look at your cost of insurance, if there's premium loads or whatever the rider fees. It's really important to understand how they can impact the performance of the underlying policy. With the policy flexibility, a lot of IULs oftentimes have flexibility in terms of the premium payment. Sometimes people, if their policy's really healthy, maybe they have a year that they need to take off because other things have happened, they can have some flexibility with that. With the death benefit, sometimes as you get older, if your insurance needs go down, a lot of the policies would allow you to lower your death benefit. And again, you have access to that cash value. So you have a couple of different features there. Really, it's kind of all tied together on really why index universal life insurance can be a well-used tool in a planning toolbox for a family that's looking for some protection and also looking for the ability to grow some cash value over time. And that really is how an indexed universal life policy works.
Yeah, I agree. I love the concept that we use for life insurance and index policies in our independent income system. And if you actually have gone through that process with us, that's the one-page document that kind of spells out your entire retirement income plan. But at the top of that document, we have an umbrella. And that's kind of the concept that I use for our index universal policies. It's almost like an umbrella policy, if you will, for retirement, in that it has so much flexibility, yet reliability, and that it is an indexed policy. And so you're not going to lose any cash value to market downturns. And you also are going to participate in most of the gains, generally the policies that we choose. And if you're not sure how it actually works or what sort of interest crediting method you should be using, we search the policies that have the highest caps, the highest participation rate, so that you get all of the earnings and all the growth that you're entitled to. But it truly is, it's almost like a utility knife. It has a lot of capabilities. You can save for retirement. You can take withdrawals from the policy to supplement retirement. It has the activities of daily living riders on it, so that if you at some point can't do 2 of the daily activities of living, policy values are accessible. So it just, and it's also reliable, and it's consistent, meaning when we try to price out how much a life insurance policy is going to be for you, when we use variable policies and policies that can fluctuate in value quite a bit, there's just a lot of, you can't really plan for that as well as you can for an investment where you're never going to lose. And I think that reliability and consistency in life insurance premiums and being able to tell a client this is the target and you should be able to expect to have to pay this for the rest of your life or however long the premium term is a nice advantage that we have with those policies.
These days, there's more that a life insurance policy can offer beyond that death benefit. Of course, that is still a major factor, but as the guys just explained there, being able to utilize it in a way as sort of a living benefit as part of that independent income system, which you can learn more about, by the way, by just hopping over to Google and looking up independent income system. It pops up right there. Or to figure out how that works specifically for you, an easier way, go to arhq.com or give a call, schedule a time to speak with the guys, 419-794-3030.